Let's get into our first discussion via email. What's called the no-cost collar, or what I sometimes refer to personally as an inverse collar. Isn't it better to pay for the put protection in a collar form up front? What is this no-cost collar? Well, as you know, we tend to advocate that a portion of your portfolio should be in protected positions via the married put following the rules in the blueprint and radioactive trading techniques. But a comparison that comes up from time to time. Instead of buying the stock and buying a put that's 5, 6, 7 months out in time and slightly in the money for a controlled single-digit risk, why not buy an at-the-money put shorter term, maybe 2 to 3 months out in time, and immediately sell a call that's 140, 150, or 160 days out? So you get a much higher premium for the call that completely covers the cost of the put, and it's called a no-cost collar. So the example that I was looking at, this was from Tuesday, I think, the 23rd. Let's say I bought AMD at $84.74 on Tuesday, and I buy an April 52 days out put at $465. This is the 82.5 strike. So kind of at the money, not the 85, bought the 82.5 for $465. And sell the July 90 call at $835. This gives me immediately $3.70 of premium, and it knocks the total cost basis out of this collar position, this no-cost collar, down to $81.04. At the shorter term expiration, that's the profit and loss graph we're looking at here. At the shorter term expiration, April, the upper break even is at $89.80, and the lower break even is at $69.32. We have the potential to make an 11% return on this position if the stock really runs, goes up to 110, 115 by April expiration. And we have a controlled max risk of 4.7%, which the worst case scenario only occurs if we're at April expiration and the stock's trading right at 82.5, our short put strike price. So this is an approach. I would call this a limited risk trade with upside profit potential. Another slight advantage, of course, it gives us 2 ways to win if the stock collapses and drops down below $69.32. So the question is, what are your thoughts on this? Well, it's not really a strategy I like to use. You do get a no-cost collar, but then again, most things we'd call a standard collar are no cost. I mean, if I just bought the stock and sold the April 85 call and bought the April 80 or the April 82.5, I'd still have a quote-unquote no-cost collar. I'd have a positive premium where the put is completely paid for. You have a low risk, but only through April, which is 52 days away. You have that high potential return, which is only going to be realized if the stock moves up almost 30%, 25%. And the max return is really only realized at July expiration, 143 days away. And of course, we have those 2 ways to win, but in order for the second way to win to kick in, it's got to drop below $69 by April. And it's almost a 20-point loss. Okay, 15, but still significant loss in that case. Our preferred approach would probably be to buy AMD at $84.74 and buy the July 90 put right away. Yeah, this gives me a higher risk of roughly 8.1%. Put would have cost me $13.20, so I have $97.94 invested per share. Is that my break even? No, that's my break even only if I hold the position all the way to July. Make no adjustments on AMD, take no income except no dividends. But if I did hold it to July, did nothing to the position, I need it trading at $97.94 in order to break even. This position we're looking at now follows the 3 core principles of radioactive trading that really apply to all trading, meaning that when we're selling premium, we want to be selling shorter term to maximize the total annualized value. And when we're buying, we want to be buying farther term to lower the annualized costs. That inverse collar, the no-cost collar, doesn't put time on our side. We want to have time decay on our side as well. And that no-cost collar locks you into a sell position where you're the one that's obligated to do something. You don't have the rights to do something. You are obligated to do something for a longer term instead of a shorter term position. Now, jumped back here for a second. Most standard collars I mentioned, no cost. This is just the example I was talking about with the standard collar. If we bought stock at 84.74, sold the March 85 call for 375, bought the March 80 put at 190, we still get a $1.85 premium. Positive premium against the position to lower the cost basis. We have a low risk of only 3.3% and only a small return for a 1-month trade of 2.7%. So it's not as high a return as the no cost or inverse collar. But this is for 22 days, not 140. Both, to me, are no cost collars. So the idea for this principle, investors who are looking to protect positions and say, why do I want to buy a put like Mike just showed that's $13.20 out to July, and then maybe sell a near-term 90 call where I'm only getting $1 and the put's not paid for? Why don't I make that the inverse? Why don't I buy the cheaper put and sell the more expensive call? Isn't it better to sell the premium right away? Well, what are your goals? What are your expectations? Are you looking to limit risk on a long-term holding for long-term? Or are you looking to have a small risk in the short term and then possibly exposure for another 100 days out in time if that put goes away? Do you want to cap the gain, or do you want to leave the upside open? See, in this case, if the stock did run up to 110, we might be close to that 11% return on the inverse collar. But if the stock goes up to 110 with the married put position, I might be closer to a 15% return, 12.5, about the same, with still protection in place for the longer term. The no-cost collar is limited term in insurance. It's only protected to April. And what do we know? That we're not going to see as much time decay in our favor on that July call between now and April expiration. Meaning, in a normal market movement over the next 60 days, we're probably going to be just near break even and a point where the put's either expiring worthless or we're selling to close it for some profit. Now I have to buy a May put or a June put to continue the trade with protection, which is going to do what? It's going to bring down that percentage return. And this is where we see how we go against the two main rules that we want with this no-cost collar. What we're looking at here is the option chain for calls and puts for AMD. And what I'm highlighting here is the April series, which is 49 days out. Get a better pen color there. The April series, which is 49 days out, and the July series here, which is 140 days out, the structures that we used in the no-cost collar. The April 90 call has a midpoint of 365 for 49 days. Let's just call it 50 days out in time. Twice the amount out of time, more than it, almost 3 times the amount out in time to July, 140 days away. The option premium is not triple, is it? It's just a little over double. And of course, this is one of those main caveats I know many of you already know. We want to sell short term because you get the higher annualized return. And on the flip side of that, the buying. We were looking at buying the April 42.5 put, which today was around 473. You can see my timestamp up there is a 1:02 in the afternoon when we were looking at this. So the 82.5 put is 473. Going almost 3 times the amount out in time, this is not $12. The cost of the 82.5 put in July is only $8.98. It's not even double, right? Double would be 940. So this is why you can see it on any option chain that the option that's 6 months out in time is not 6 times the cost, which reinforces that when we're buying, we want to be buying further out in time to lower the annualized cost per day. And when we're selling, we want to be selling shorter term to maximize the annualized premium taken in that case. The structure of the no-cost collar is opposite, which is one of the reasons why I don't prefer to use it, because it goes against those basic concepts of options trading. The second rule is the time decay curve. And what you expect when you're 150, 160 days out in time, of course, is up in this range. You're going to start to see a very slow time decay on your option. Whereas I'm 60 days out, I start to see a more rapid decay. And the last 30 days, we lose all time value that we have left, especially as we get closer to expiration. What does that tell us? That tells me I'm going to want to be selling here to get the more rapid time decay in my favor month by month and also increase my annualized return from selling shorter term. But when I'm buying, I want less time decay to go in my favor in the first 30, 60, 90 days before it really starts to trail off and that insurance cost I paid starts to deteriorate rapidly. The no cost, or what I call the inverse collar, is doing the opposite. It doesn't follow the time decay curve line correctly, and it's not following the rules of maximizing annualized return by selling shorter term and buying longer. We're doing the reverse. Does this all really even matter if you're comfortable with the position? Well, let's take a look. Let's break down these two positions. We're going to quickly navigate over to power options. And there we go. What we're going to do here is I already input these two positions into our portfolio. Get off my arrow there. And we just want to take a look at what would happen at April expiration if the AMD no-cost collar hit break even. And then what would happen to the married put? And ignore the riot one here. That's for Troy's question in just a moment, the second email question. So let's go ahead and just go to the profit and loss chart as I'm tracking these positions in the portfolio. By the way, I put in the prices, as I mentioned, on 223. The stock's moved up, not much at all. 84.74 was the stock price on Thursday. There's my July put at 1320. Here's my inverse / no cost collar on this position. What's interesting is that right now, with only a small movement and some implied volatility fluctuation, which hurt the call and didn't help the shorter term put as much, the married put by itself is up $31. Okay, it's 0.3% of the investment. But here you're only up $1 with the market moves and change of implied volatility on AMD over the last couple of days from Thursday to now. But let's take a longer term look rather than drops in the bucket of what happened in the last 3 days. Let's go to our profit and loss chart. There's the no cost collar we mentioned. Okay, and I got to jot this down. I want to see what happens when it's at 110 as well. As we mentioned, we do have the benefit in this no cost collar of an upper and lower break even. But my upper break even, 89.95, let's call it. Okay, so what would happen? I know we'd be close to break even, but let's just look at it. If AMD moves up to 89.95 at April expiration, down here below the profit and loss chart, we use this calculate field. That makes sense. We're at break even, plus or minus $1, no big movement in that case. What's important to note here? What's important to note is the call actually increased in price. Theoretically, how is that possible? The put went to zero. It expired worthless. How is this even possible that we could pass 60 days in time and see the option increase in value? That goes to a third rule that we use in radioactive trading, known as the at-the-money bell curve. We bought the stock here at about 85, and we sold the out-of-the-money 90. Okay? The at-the-money bell curve you look at any option chain, the option that is closest to the current stock price, in this case, if it was $85 that we looked at on Thursday, the 85 strike call in any month would have the highest extrinsic or highest time value. As the stock gains, the options that were out of the money or in the money in the case of our married put position, the 90, that's now at the money, and the time value can actually increase even though time has passed, because we've moved from slightly out of the money to at the money, and we get that at the money bell curve swelling up. So here we are at break even, but why is this important? 60 days have passed, and you say, oh, after 60 days, I'll be able to buy to close my call for a cheaper price and be at a profit. No, you're just at break even here. And now what do we have to do? We have to decide how to move forward. This is gone. This expires worthless. And this goes up cost basis. We just lost $4.65. So we've got to account for that by adding it back into the stock price. So 84.74 plus that 4.65 would put us at 89.39 if my math is correct. Now, from April to July, you've got a covered call, 90 strike, and the stock's right about there. You don't have any profit. You're still at break even due to the buyback cost of that short call, and still the potential to make 11% return. But you don't have any protection here if the stock reverses from this recent 5% move or so. Now what do you have to do? Got to buy another put. So let's just simulate what happens if I bought a May. We're assuming it's April. So I'm going to say this is a May put. We're going to buy the 82.50 put, and let's just put out another 268. We're only going 1 month out now. Since we're not at a profit, can't liquidate for a profit on this position. And now we have a higher risk, a bigger, what we like to call Death Valley in here, and we've taken 4% off the maximum return to continue the trade for another 30 days with protection in place because the call has not decayed as we originally expected. Now, I had mentioned, let me go back to the main one. In that case, why did that change? Oh, it's on a different date. I'm sorry, that's why. Okay. So, I'm sorry, what I want to do now is, I had mentioned if the stock goes up to 110, right, almost a 30% movement in AMD, who knows? But if the stock goes up to 110 by April expiration, where would we be at? Okay, so according to this, we'd get we have a high cost on the call now because it's deep in the money, but we're roughly going to get assigned or be close to intrinsic. We're not fully at the max profit, are we? The max profit here is at 862. In this case, we're not there yet. Am I in the right stock? Yeah. So we're only expecting a profit here just due to the buyback cost. And even though this 90 call is 20 points in the money, remember, it's still out to July, so there's still time value to have to buy it back. Okay, so we're not near that 11% profit we expected yet. Why did I want to run that scenario? Profit of 587 on the position. Because what I want to do now is let's take the married put position. Let's do the same thing. This would be the married put. I do have a risk of 8.1%. I don't have two ways to win, as opposed to the no-cost collar. But in our example of 89.39 or so, that break even, I believe it was, 89.50, somewhere in that range, on again, expiration of April 16th. Okay, not great because of the expected time decay here and the higher volatility of 0.51. But again, we'd see a profit on the position instead of a break even. This is a very high volatility, so I think it might actually be inflated a little bit, but that's okay. This is the next 60 days, stock moves up. I wouldn't expect to see $400 decrease in this put, but it might be possible. What happens now if we jump to 110? Remember, we saw a $587 profit on the no-cost collar. Not near the maximum 897, 1508. Okay, so That's a fair percentage return. Yeah, it's almost a 15, 17% return off the investment of 97.94. I don't have two ways to win with the married put approach that we prefer, but what I do have is more of an upside advantage because I didn't sell a call that's so far out in time that's going to take longer to decay in my favor as the stock moves up and down. If I'm really bullish on a position, I want to use the married put structure. I don't like that no-cost inverse collar approach because it's opposite of what we'd expect to do in those situations. And so just real quick, let me navigate back over now. There we go. And I just want to sort of wrap this up real quick. I know that I am missing some things, okay? The educators who teach this probably have rules on when to manage the shorter term put if the stock's stagnating, to roll down the call or move the call in some function, or maybe just leaving it as a covered call in that first 40 to 60 days if the stock doesn't do what you want, and you still look for the 11% profit going forward for 140 days out. Again, you do have two ways to win with this structure, but you have a deep, what we call Death Valley or no man's land. That check mark in there is pretty wide where losses are realized. And again, this is why I prefer to use the married put approach that we just showed, following in the rules in the blueprint at radioactivetrading.com. The blueprint is $349, but it goes through the entire structure that we like to use for the married put. It forces those three core principles: forcing an ideal size trade, at the money bell curve, the income methods, maximizing the premium in the shorter term against that proper protected structure where the put is bought out farther term. And when the put is out farther term, like we showed with the July, it's not just a wasting asset. It is a second asset that we can manipulate four ways. Well, technically three. There's three ways to manipulate that put discussed in the 12 income methods in the blueprint to adjust the position, lower the initial at risk, and lower the cost basis as well, depending on the stock movement. Our blueprint's all electronic, so we don't mail out the physical binder anymore. And of course, any member who purchases the blueprint, anyone who owns the blueprint, you also get access to members-only content as well.